Imagine starting with just $10 a day and over time accumulating more than $1 million. Sounds impossible? It's not. Today, you'll learn how to apply a simple yet powerful strategy called dollar cost averaging, DCA, which can transform small daily contributions into real wealth. Many young people delay important financial decisions because they think they need large sums to start or are afraid of risks. But the truth is that the financial market offers opportunities for everyone, especially those willing to be consistent and patient. The key to gradually building wealth lies in understanding the power of compound interest and having the right mindset. Investing small amounts regularly is far more effective than trying to time the market perfectly. With the concept of DCA, you invest fixed amounts at regular intervals, regardless of market conditions. This reduces the impact of volatility and eliminates the need to predict future movements. Plus, starting early means giving your money more time to grow exponentially. But where should you invest? Low-cost assets like index funds and ETFs are ideal for beginners. They offer diversification, low fees, and simplicity, allowing you to get started without complications. For example, by investing in an S&P 500 index fund, you're buying a slice of some of the largest companies in the world. These assets are easy to access and manage, especially with intuitive digital platforms that automate your contributions. Just set up automatic transfers to your investment account and let the system work for you. To illustrate this, let's do a practical simulation. Imagine you start investing $10 a day at age 25 in an S&P 500 index fund, which historically yields about 7% annually. By age 65, you will have accumulated over $1 million. The secret here is consistency. Small, daily steps lead to big results over time. Visual charts clearly show how exponential growth works, comparing sporadic investments versus regular ones. However, many people make common mistakes when investing, trying to time the market, abandoning investments during downturns, or failing. To automate contributions can hinder your progress. To avoid these mistakes, focus on long-term strategies and stay resilient during periods of volatility. Remember, time is your greatest ally in the financial market. The earlier you start, the better the final outcome. Inspirational stories also show that anyone can achieve financial success with discipline. People who started with little and used this simple approach managed to build significant wealth over the years. These stories reinforce that you don't need much initial capital, just the willingness to start. For instance, consider someone who began investing just $10 a day and decades later retired comfortably. These examples prove that small actions today can lead to life-changing outcomes tomorrow. Additionally, there are free tools and resources that can help you plan your investments and track your progress. Apps and digital platforms make it easy to manage your finances and allow you to adjust your strategies as needed. By exploring these options, you can find even more efficient ways to maximize your earnings. For example, apps like Robinhood or Acorns simplify the process of automating investments, making it accessible even for complete beginners. Dealing with market volatility is another important challenge. While fluctuations are normal, the key is to stay focused on the long term. Historical examples show that markets always recover after economic crises. So don't panic during downturns. Instead, see them as opportunities to buy assets at lower prices. This mindset shift can make a huge difference in your journey toward financial independence. Over time, you can expand your strategy. As your portfolio grows, consider diversifying your investments into other asset classes, such as real estate or cryptocurrencies. Reinvesting profits can further accelerate your wealth growth. However, remember that diversification is crucial to minimizing risks. For example, while stocks might offer high returns, bonds or real estate can provide stability during uncertain times. Now let's dive deeper into why starting early is so critical. Compound interest is often called the eighth wonder of the world for a reason. When you reinvest your earnings, they generate even more earnings over time. This snowball effect is what allows small contributions to grow into substantial wealth. For instance, someone who starts investing at 25 will have significantly more money by retirement than someone who begins at 35, even if both invest the same amount monthly. Time truly is your best friend in the world of investing. Another important aspect is understanding the psychology behind saving and investing. Many people struggle because they lack clarity about their goals or fear losing money. To overcome this, focus on setting specific, measurable objectives. For example, instead of saying, "I want to be rich," define exactly what that means. "I want to accumulate $1 million by age 65. Having a clear target makes it easier to stay motivated and committed to your plan. Let's talk about the tools you'll need to succeed. First, open a brokerage account with a platform that suits your needs. Look for one with low fees, user-friendly features, and educational resources. Next, choose an asset allocation that aligns with your risk tolerance and financial goals. If you're unsure where to start, consider consulting a financial advisor or using robo-advisors, which provide automated investment recommendations based on your profile. As you continue your journey, it's essential to monitor your progress regularly, but not obsessively. Checking your portfolio daily can lead to emotional decision-making, especially during market swings. Instead, review your investments quarterly or annually to ensure they remain aligned with your goals. Adjustments may be necessary as your circumstances change, but avoid making impulsive moves based on short-term trends. Here's a crucial point: never underestimate the power of education. The more you know about investing, the better equipped you'll be to make informed decisions. Read books, listen to podcasts, and follow reputable financial experts to stay updated on market trends and strategies. Knowledge is your ultimate weapon against uncertainty. Let's address some common objections people have about investing. One frequent concern is, what if I lose all my money? While no investment is entirely risk-free, choosing low-cost index funds or ETFs significantly reduces your exposure to unnecessary risks. Another objection is, I don't have enough money to start. But as we've discussed, even $10 a day can make a massive difference over time. The key is to take action, no matter how small. Now let's revisit our simulation to emphasize its potential impact. By investing just $10 daily in an S&P 500 index fund, you could accumulate over $1 million in 40 years. That's assuming a modest annual return of 7%, which is well within the historical average. If you increase your contributions as your income grows, the results become even more impressive. For example, raising your daily investment to $20 would double your total accumulation, showcasing the scalability of this strategy. At this point, you might be wondering, how do I stay disciplined? Discipline comes from habits, and habits are built through repetition. Start by automating your contributions so you don't have to think about it. Treat your investments like any other recurring expense, such as rent or utilities. Over time, this practice becomes second nature, and you won't miss the money you're putting aside. Let's explore a real-life example to inspire you further. Meet Sarah, a 27-year-old teacher who decided to take control of her financial future. She started investing $10 a day in a low-cost ETF and stuck to her plan despite market ups and downs. Fast forward 20 years, and Sarah now has a six-figure portfolio that continues to grow. Her story proves that consistency beats perfection every time. For those worried about inflation eroding their savings, investing offers a solution. Unlike cash sitting in a bank account, investments in stocks or ETFs have the potential to outpace inflation over the long term. This means your purchasing power can actually increase, providing greater financial security in retirement. Another advantage of this strategy is its flexibility. You can adapt it to fit your unique situation. For instance, if you receive a bonus or tax refund, consider adding a lump sum to your investments. Alternatively, if you experience a temporary setback, reduce your contributions temporarily without abandoning the strategy altogether. Flexibility ensures sustainability. Let's discuss overcoming procrastination, a common barrier to financial success. Many people delay investing because they feel overwhelmed or unsure where to begin. The truth is, perfection isn't required. What matters most is taking the first step, no matter how small. Once you start, momentum builds, and the process becomes easier over time. Finally, let's talk about legacy. Beyond achieving personal financial freedom, investing allows you to create opportunities for future generations, whether it's funding, your children's education, or leaving a meaningful inheritance. The impact of your efforts extends far beyond yourself. This sense of purpose can be a powerful motivator to stay committed to your goals. In summary, small daily contributions can transform into significant wealth over time. With the right strategy, low-cost assets, and consistency, you can achieve financial independence. Remember, the future starts today. Make your first contribution now and take the first step toward a more secure and prosperous tomorrow. If this video was helpful, give it a like and share it with your friends. Subscribe to the channel for more content about personal finance and investing. Together, we can build a better future for our families.